Very good, dear friends. In this video, we will discuss about the topic on income from house property, and we'll see how to compute income under this head. And we will look at the basis of charge and the computation under this head, and also certain special situations. Now, the charging section is section 22. And we now look at what is charge under the head IHP, and this is provided by section 22. As per section 22, the annual value of a property of which the assessee is the owner and which is not occupied by him for business or profession carried on by him is chargeable to tax under the head IHP. So annual value is computed as per the provisions, and that is the amount that is chargeable to tax under the head IHP. The annual value needs to be of property, that is buildings or lands appurtenant thereto. So annual value not only of the buildings but also of lands appurtenant thereto is chargeable under the head IHP. Lands appurtenant thereto means land which are integral or which are attached or which are connected with the building, right? So their treatment is also the same as the building to which they are appurtenant. Now, as far as building is concerned, the meaning of building is quite wide. It not only includes residential buildings but also commercial buildings. So house, factory, office, shop, godown, etc. is covered within the purview of the term building. And therefore, building does not mean only house, right? So annual value of a building is charged to tax under IHP. As far as lands appurtenant to the building is concerned, the examples may be of a garden or a courtyard, approach roads, playground, etc. So if the land is appurtenant or it is connected with the building, the annual value of the property as such, that means building plus land appurtenant thereto, is charged under the head IHP. What about vacant land? As far as income from vacant land is concerned, it is not taxable under the head IHP, it is taxable under the head PGBP or IFOS. The condition is that the assessee should be the owner of the property. Only then the annual value is chargeable under the head IHP. So where assessee is not the owner of the property, income is dealt with under the head PGBP or IFOS but not IHP. Now the building will definitely be standing on land. And while it is necessary that the assessee should own the building, it is not necessary that assessee should also own the land on which the building stands. The important condition for charge under the head IHP is that the property should not be occupied by the assessee for business or profession which is carried on by him. So where the property is occupied by the assessee for his business or profession, computation under the head PGBP comes into play. And annual value of such building is not charged under the head IHP. But in case income from property is held as a stock in trade, for example in the case of a real estate developer, then income therefrom is taxable under the head IHP. Then income from that means the annual value in respect of stock in trade is taxable under the head IHP. As far as a farmhouse which is used for agriculture is concerned, that means a building, maybe storehouse or a dwelling house, etc., which is on or in the immediate vicinity of an agricultural land. We have already noted in the video on exempt income that income from such farmhouse or building is exempt as agricultural income under section 10(1). Now, as far as the scope of taxation is concerned, we have already noted this in the video on residential status and scope of total income. And basically what we saw is if the income is Indian income, then it is taxable for all irrespective of the residential status. But if the income is foreign income, then it is taxable in the hands of ROR on global taxation basis, but not in the hands of a RNOR or a non-resident. Therefore, income from property is taxable in India if it is Indian income. That means it accrues or arises in India, or is deemed to accrue or arise in India, or is received in India, right? We also noted that when is the income from a property deemed to accrue or arise in India? Income from property in India. Income from property in India. That means if the house property is situated in India, then income is deemed to accrue or arise in India, in which case the income from house or property is taxable in the hands of all persons irrespective of their residential status. Now, annual value of a property is charged under the head every year, and it needs to be computed every year, and therefore the conditions, the charging conditions under section 22 need to be fulfilled every year. We will now look at the various types of properties. The tax treatment under the head IHP is different for different kinds of properties. And how is a property classified? So the property can either be a let out property, which is called LOP. It can either be a self-occupied property or SOP. It can be an unoccupied property or UOP. The tax treatment can also be as a DLOP or deemed to be let out property. So let's see. If the property is let out, then the tax treatment is that of an LOP or a let out property. Where the property is an occupation of the owner for purposes of his own residence, then it is treated as SOP or self-occupied property. Now there could also be a property which cannot actually be occupied by the owner. Why? Because owing to his employment, business or profession, which is carried on at any other place, he has to reside at that other place in a building not belonging to him. So the owner has a property in Delhi, but he cannot occupy the property in Delhi. Why? Because owing to his employment, business or profession carried on, say, in Chandigarh, he has to reside in Chandigarh in a building not belonging to him. So therefore, the property in Delhi is unoccupied and it is called as UOP or unoccupied property. Now, what is the tax treatment in respect of SOP or UOP? Where such property, we are talking about SOP as well as UOP, where such property consists of up to two houses, then the tax treatment of those up to two houses is that of SOP or UOP. However, where such property consists of more than two houses, so SOP and UOP properties are more than two, then the tax treatment is that of SOP or UOP, but only for up to two houses. For up to two houses, and those two houses can be specified by the SSE at his option. And this option can be changed every year. So the SSE can make selection every year in a manner most beneficial to him and decide out of the properties which are the two properties which he want to characterize as SOP or UOP. As far as other houses are concerned, they are treated as deemed to be let out property or DLOP. So even if those houses are not actually let out, they are classified as deemed to be let out and the tax treatment is that of DLOP. Finally, as we noted above also, that property which is occupied by the SSE for the purposes of his own business or profession is not covered under the head IHP. So this is how the property is classified and tax treatment depends on the classification. So classification of a property as self-occupied or unoccupied property is possible only in case of a natural person. That means in the case of an individual or HUF, right? Because the other persons cannot actually reside or use the property as their residence. Now, as far as SOP or UOP is concerned, what we need to note is if the property is actually let during the previous year, and it may be let out for the whole of the previous year or even for any part of the previous year, even for just one day, or if any other benefit is derived by the owner from such SOP or UOP, then the tax treatment is changed. Then the property is not treated as SOP or UOP, rather it gets treated as a let out property or LOP. So if the property is actually let during the whole or any part of the previous year, or any other benefit therefrom is derived by the owner, then the tax treatment is changed to that of a LOP. Further, if the SOP or UOP remains vacant for the part of the previous year, it is vacant for a part of the previous year, then it doesn't matter. It continues to be treated as SOP or UOP. Now we will look at the master chart for computation of income under the head income from house property. As we noted, the tax under the head IHP is based on the annual value. Annual value is a notional income. It is not the actual rent, right? It is basically the capacity of a property to yield income. So there is a method of computation, and this method varies from an LOP or SOP, UOP or a DLOP, and there are various factors which are relevant or which come into play in the computation of income under this head. So let's see how to compute income across various kinds of properties. So first we will pick up the case of a LOP, and the step 1. So basically there are 6 steps in all, and the 7th at the end of this, towards the 7th step, we come to the result, which is the income under the head IHP. So the first step is to figure out the value of expected rent. And expected rent is the higher of fair rent of the property or municipal value of the property, but it cannot exceed the amount of standard rent. Expected rent basically is the rent that one can expect from the property. And this is not actual rent, this is the expected rent, and therefore it is higher of fair rent or municipal value but restricted to the amount of standard rent. In the second step, we determine the actual rent. The actual rent which is received or receivable during the year. We also deduct any unrealized rent if certain conditions are fulfilled. In step 3, we arrive at the value which is the gross annual value or GAV. And GAV is what? GAV is higher of expected rent or actual rent. It is the higher of expected rent or the actual rent. Now there may be certain situations in which a let out property has been vacant, right? In certain cases, the GAV is not the higher of expected rent or actual rent, but a benefit is provided whereby the GAV is equal to the actual rent if certain conditions are satisfied, and we will discuss about that in some time. So this way we arrive at the figure of gross annual value. From the gross annual value, we now start making the deductions as allowed under the Act. From the gross annual value, we make deduction on account of municipal taxes actually paid during the year by the owner. And this gives us the figure of NAV or the net annual value in step 5. In step 6, there are 2 deductions which are provided under section 24, and we reduce those amounts. The first is on account of standard deduction at the rate of 30% of NAV. At the rate of 30% of NAV. And secondly, we provide deduction on account of interest on borrowed capital to the full extent. And therefore the result is income under the head IHP, which can either be income or a loss. Now we look at computation for a SOP or UOP. And as we know, the computation mechanism is the same for SOP as well as UOP. Now for an SOP or UOP, straight away we jump to step 5, which is the NAV, and this is taken as nil. This is taken as nil. And consequently, as far as deductions under section 24 are concerned, a standard deduction is not relevant because the NAV itself is nil. What is left to be deducted is interest on borrowed capital. But here, interest is not deductible without any limit. There is a limit of either 30,000 or 2 lakh, and therefore what the result is a loss under the head income under the head IHP, and the loss can be at most 30,000 or 2 lakh depending on the quantum of interest on borrowed capital. How do we compute income for a DLOP, deemed to be let out property? Now, since the property is not actually let out, but it is deemed to be let out, the treatment is basically similar to that of a LOP or a let out property, right? Treatment is similar. So we first figure out the expected rent. Now here lies the difference, that gross annual value for a LOP is higher of expected rent or actual rent, but since there is no actual rent in the case of a DLOP, right? So the gross annual value by default becomes the expected rent or ER. For a DLOP, then there is no question of unrealized rent as well as vacancy allowance. Then just like LOP, we deduct the municipal taxes, and which gives us the figure of NAV, from which we provide deduction on account of standard deduction at 30% of NAV and interest on borrowed capital, and consequently we get the result as income or loss under the head IHP. So this is how we compute income for a LOP, for SOP or UOP, and for a DLOP. Now certain points to note. In case of a SOP or UOP, the result will always be a loss because the deduction is only on account of interest on borrowed capital and NAV is taken as nil. But in case of LOP or DLOP, the result can either be income or loss because there is a positive NAV from which deductions are provided. As far as SOP or UOP is concerned, the only component relevant in computing IHP is interest on borrowed capital because NAV is nil and this is the only component which needs to be deducted. And therefore, the maximum loss for SOP or UOP cannot exceed rupees 30,000 or 2 lakh, which is basically the limit for interest deduction. But for a LOP or DLOP, the items that we deduct are on account of municipal taxes or interest on borrowed capital. Also the standard deduction, which is a percentage of NAV, and therefore there is no limit to the amount of loss. Now there could be a situation where the property is not in existence during the whole of the previous year, or it comes into existence only midway during the previous year. If the property is not in existence during the previous year, income therefrom is not chargeable under the head IHP. It is not chargeable because property itself doesn't exist. If the property comes into existence, that means if it is acquired or its construction is completed during the course of the previous year, midway, then the annual value is computed only for the proportionate period. That is, for the period while the property is in existence, from the day the property comes into existence to 31st March of the previous year. So annual value, we are talking about annual value. So we are talking about this particular component. So this is computed proportionately, but as far as the other elements are concerned, that is municipal taxes or deduction on account of interest on borrowed capital, it is not allowed proportionately, it is allowed in full. Therefore, the other values, that is municipal taxes and deductions under section 24, should be allowed in full and should not be reduced proportionately. There is a separate video that I have created for computing income from house property in this situation, and for detailed example and illustration you can look at that video. Now we will discuss each of the items or elements that we have seen in this master chart for computation here on. So first we look at expected rent, actual rent, and GAV, and the relevant section is section 23.1. So as we saw in the master chart for computation above, what is the step 1? Step 1 is to compute the expected rent. And what is expected rent? Expected rent is the higher of A, fair rent, or B, municipal value. However, it cannot exceed the standard rent. So this is what we saw in the master chart. Expected rent, which is higher of fair rent or municipal value but is restricted to standard rent. Now what is fair rent? Fair rent is the rent from a similar property in the same or similar locality, and therefore it is also called reasonable rent. It is also called reasonable rent. So the question may either refer to reasonable rent or fair rent. It means one and the same thing. What is municipal value? Municipal value is the value determined by the municipal authority for levy of municipal taxes. For levy of municipal taxes, this is the municipal value. Now the higher of fair rent and municipal value cannot exceed the amount of standard rent. What is the standard rent? So standard rent is the rent fixed under Rent Control Act. Now each state has its own Rent Control Act, and the standard rent is as per that Rent Control Act. And basically rent cannot be legally charged more than the standard rent, and hence the expected rent also cannot exceed the standard rent. Now this was a step 1. What was a step 2? What was a step 2? After computing expected rent, step 2 was to compute actual rent. Now actual rent denotes what? It denotes the actual rent which is received or receivable by the owner during the previous year. And once we find out the expected rent and the actual rent, consequently, the gross annual value is determined, which is the higher of expected rent or actual rent. This is the amount of gross annual value which we saw in the master chart. Now the concept of expected rent is not really relevant in the case of SOP or UOP. Why? Because the gross annual value in that case is nil. In fact, the NAV is nil. Only the deduction on account of interest is provided. So the concept of expected rent is not relevant in that particular case. The question may not always give all the figures to compute expected rent. It may not provide the value of fair rent or municipal value or standard rent or all of them. So in that case, we need to compute the GAV and give a note in the answer making appropriate assumptions. So we can say, for example, if the fair rent or the municipal value or standard rent is not given but only the actual rent is given, that we can say that the value of actual rent is being taken as the GAV in absence of any further information in the question. So depending on the facts of the question, we can make suitable assumptions, give a note, and then do the calculations. We now look at the concept of unrealized rent. So as we saw in the master chart, we compute actual rent. And while computing actual rent, we deduct the amount of unrealized rent from the value of rent received or receivable during the year. And that becomes the actual rent, which is then considered in computing the GAV. Now this is dealt with by Rule 4, right? And the unrealized rent is required to be deducted from actual rent only if the conditions specified by Rule 4 are met. What is unrealized rent? It is rent which is payable but is not paid by a tenant. Not only that, it should also be proved to be lost and irrecoverable. So rent which is payable but not paid by a tenant and which is proved to be lost and irrecoverable is called unrealized rent. There are certain other conditions to be fulfilled, and there are 4 of them. The tenancy is a bona fide tenancy, right? It is not fake or fraud. The defaulting tenant has vacated the property, or steps have been taken to compel him to vacate the property. It cannot be that the defaulting tenant is staying or he continues to be stay. In that case, we cannot claim deduction of unrealized rent. Third, the defaulting tenant is not in occupation of any other property of the SSE. If he has defaulted in paying rent for one property of the SSE, but he is still staying in another property of the SSE, deduction of unrealized rent for the first property cannot be claimed. Fourth, the SSE should have taken all reasonable steps to institute legal proceedings for the recovery of the unpaid rent. So either he should have taken all reasonable steps to institute legal proceedings, or if that is not done, he should have satisfied the AO that legal proceedings, if taken, would be completely useless. So if these 4 conditions are fulfilled, only then the unrealized rent is allowed to be deducted from the actual rent to compute GAV. Else, unrealized rent is not deducted from the actual rent to compute GAV. Now we should note that unrealized rent is not relevant. This concept itself is not relevant in the case of a SOP or UOP or DLOP, because there is no rent to be realized in the first place. Such properties are not let out in the first place. We will now look at the concept of vacancy allowance. So going back to our master chart, what we noted was that higher of expected rent or actual rent is the gross annual value. However, gross annual value is the actual rent, not a higher of expected rent or actual rent, right? In case of vacancy, if certain conditions are satisfied. So that means if certain conditions are satisfied in case of a vacancy, then gross annual value is taken as actual rent, even if expected rent may be more than the actual rent, right? So higher of expected rent or actual rent is not taken. So this is in the nature of a benefit. Now let's look at this concept briefly. So where the property or any part of the property is let out and it was vacant during the whole or any part of the previous year, right? So the property is let out for say the whole of the previous year and it was say vacant for a period of 2 months. That means a part of the previous year. And owing to such vacancy, that means because of such vacancy, the actual rent in respect thereof is less than what? Is less than the expected rent. That means because of vacancy, the actual rent goes below the level of expected rent. Then benefit is that of vacancy allowance. And therefore, the actual rent is taken to be the GAV and not the expected rent, even if it is higher than the actual rent. So there are two steps to be followed. And let's take an example. So there is a property where the expected rent, which is higher of fair rent or municipal value subject to standard rent, is say 1,10,000 rupees for the year. And the rent is 10,000 per month, so the annual rent is 1,20,000, which is more than the expected rent, right? So if there is no vacancy, then higher of 1,20,000 or 1,10,000 will be taken as the GAV, which is the actual rent of 1,20,000. But say the property is vacant for a period of 2 months, and that means we receive the rent only for a period of 10 months, and therefore the actual rent is 1 lakh rupees. Now, as per step 1, what we need to do is we need to compare the actual rent of the property, and mind you, when we pick up the actual rent, that is after reducing the unrealized rent if any, if the conditions of rule 4 are fulfilled. We need to compare the actual rent of the property with the expected rent. So we need to compare what? We need to compare 1 lakh actual rent of the property with expected rent, and which is 1,10,000 rupees. In step 2, we need to see if actual rent is less than expected rent. So actual rent is 1 lakh and it is less than expected rent of 1,10,000, and that is owing to vacancy. Because of the vacancy of 2 months, the actual rent has become 1 lakh, which is less than expected rent, right? If vacancy was not there, then the actual rent would have been 1,20,000, which would not have been less than expected rent. So only owing to vacancy, the actual rent falls below expected rent. In such case, vacancy allowance will be available and gross annual value will be actual rent. So gross annual value will be 1 lakh rupees actual rent. So the normal rule will not apply and the GAV will be taken as the actual rent. Now vacancy allowance is provided where actual rent is less than expected rent only due to vacancy. It should only be due to vacancy, right? Which is the case in our example. In other words, but for the vacancy, the actual rent would have been equal to or more than the expected rent. So if the vacancy was not there, the actual rent would have been 1,20,000 more than the expected rent. So therefore, due to the benefit of vacancy allowance, actual rent is taken to be the GAV, even if it is less than expected rent. So here actual rent is 1 lakh, which is less than the expected rent, but even then it is taken to be the GAV, and this is the benefit of vacancy allowance. If the vacancy allowance was not available, then what would have happened? Then expected rent would have been taken to be the GAV. 1,10,000 would have been taken to be the GAV because it was higher of 1,10,000 or actual rent of 1 lakh rupees. Now where vacancy allowance is not available, the normal rule applies, and there the GAV is higher of expected rent or actual rent. And when is vacancy allowance not applicable? Where actual rent is anyways equal to or more than expected rent with or without vacancy, right? With or without vacancy. So for example, if here the expected rent instead of 1,10,000 was say 80,000, then the actual rent without vacancy would be 1,20,000 and actual rent with vacancy would be 1 lakh. In both the cases, it will anyways be more than expected rent, so vacancy allowance will not apply, right? Vacancy allowance is also not applicable where actual rent is less than expected rent. but for a reason which is other than the vacancy. So vacancy allowance is only available where actual rent is less than expected rent only on account of vacancy. Now, as we noted above, actual rent should always be taken after deducting unrealized rent if Rule 4 conditions are satisfied. And if those conditions are not satisfied, unrealized rent will not be deducted. Vacancy allowance is available where the property is let out and is vacant during the whole or part of the previous year. Vacancy allowance is not relevant when in the case of a SOP or UOP where NAV itself is taken to be nil. NAV itself is taken to be nil, so therefore the concept of vacancy allowance is not relevant in the case of SOP or UOP. So we have so far discussed how to compute expected rent, how to compute actual rent, and how to deduct unrealized rent, how to compute GAV, and how to provide for vacancy allowance. Now, once we have arrived at the amount of GAV, then we need to provide for a deduction on account of municipal taxes. And this deduction is provided in the case of LOP and in the case of DLOP. For SOP or UOP, this is not relevant because NAV itself is taken to be nil. So now let's see what is the deduction allowed on account of municipal taxes from the GAV to arrive at the value of NAV or net annual value. The deduction is allowed on account of municipal taxes, that is, taxes levied by any authority in respect of the property, actually paid during the previous year by the owner. So, three conditions. Deduction is allowed only if the taxes are actually paid. When? Actually paid during the previous year. By whom? By the owner. And then we arrive at the NAV. So municipal taxes are therefore deducted only on payment basis, not on due basis. And this is irrespective of the previous year in which liability to pay such taxes was incurred by the owner as per the method of accounting followed by him or her. So if municipal taxes are not paid, these are not deducted, even though they have become due. Now, sometimes local authority levies service taxes also. For example, sewerage tax, water tax, etc. And municipal taxes are deemed to include service taxes as well. So, municipal taxes are not deducted if they are not paid during the previous year. Municipal taxes are not deducted if they are not paid and borne by the owner. So, if the tenant is paying the municipal taxes, deduction is not provided. Now, as far as SOP or UOP is concerned, we have already noted that municipal taxes are not deducted because GAV itself is nil, because NAV is taken to be nil. The deduction of municipal taxes is therefore provided only in the case of LOP or DLOP. Sometimes in the question, municipal taxes are given in the question as a percentage. So municipal value will be given, for example, 10 lakh rupees, and it will be given in the question that municipal taxes are levied to the extent of, say, 1%. So we need to apply the percentage to the municipal value. So the municipal taxes will be 1% of 10 lakh rupees, and accordingly, the deduction of municipal taxes will need to be provided. So once we provide deduction of municipal taxes, we arrive at the value of NAV, which is nil in the case of SOP or UOP and a positive figure in the case of LOP and DLOP. From the NAV, as we noted already, we provide deductions under section 24. There are two deductions which are provided. The first is a standard deduction, which is provided at the rate of 30% of NAV. Since the NAV is nil for SOP or UOP, standard deduction is provided only in the case of LOP or DLOP. LOP or DLOP. So standard deduction is 30% of NAV. It is a flat deduction and it is allowed to this extent irrespective of the actual expenditure incurred on the property. The actual expenditure doesn't matter. The objective of providing standard deduction is basically to account for various expenses that the assessee may incur in respect of the house property, and it is a flat amount, not the actual expenditure. Standard deduction is given from the NAV, not from the GAV, right? No separate deduction is allowed for expenses like repair and maintenance of the property, insurance premium, electricity, water, etc. So even if these amounts are given in the question, do not allow deduction because all these expenses are subsumed by the standard deduction. right? In the question, sometimes the income from house property will be given. For example, in the total income question, the amount will be given and it will be stated this is the income from house property, and it may be stated within bracket that it is computed. Now when it says that it is computed, it means that it is the income under the head income from house property. So everything has already been taken account of. That means a standard deduction has been applied. So you should not give a standard deduction once again on the computed income that is already given in the question. On the other hand, sometimes in the question, only the amount of rent may be given. That this is the rent, say, of 5 lakh rupees, that's it, no other information is given. In such case, it means that it is definitely not the income computed under this head, and therefore you should compute the NAV based on whatever information is available and then apply the standard deduction to finally arrive at the income from house property. So while computing the total income, what you will need to include is the income computed under the head income from house property, right? So if anything else is given, then you need to pick that up and then arrive at the income taxable under this head, and that particular computed income will enter the computation of total income. We will now look at section 24B, which provides for the second deduction under section 24 in respect of interest on borrowed capital. Let's look at the chart. Interest payable on borrowed capital is allowed as deduction where the property is either acquired or constructed or repaired or renewed or reconstructed with borrowed capital. In these 5 cases, interest is allowed as deduction. Now, if this is in respect of a LOP or DLOP, interest is fully deductible, there is no limit. If the interest is in respect of SOP or UOP, up to 2 houses. Up to 2 houses, why? Because property in addition to 2 houses is classified as DLOP, for which there is no limit, interest is fully deductible. So in respect of SOP or UOP, we need to see whether the property is repaired, renewed or reconstructed, or it is acquired or constructed. So construction and reconstruction are not the same, right? If the property is repaired or renewed or reconstructed with borrowed capital, then the deduction is a maximum of 30,000. So if interest is 1 lakh, 70,000 will not be allowed, 30,000 will be allowed. If the property is acquired or constructed with borrowed capital, then we need to see when is the capital borrowed, when is the loan taken. If capital has been borrowed before 1st April 1999, then the limit of deduction remains the same at 30,000 rupees, right? However, if the capital has been borrowed on or after 1st April 1999, then if further 2 conditions are satisfied, the deduction limit is enhanced to a maximum of 2 lakh rupees. So this 30,000 gets enhanced to 2 lakh rupees. If these conditions, if both of these conditions are not satisfied, then the deduction remains limited at 30,000. What are these 2 conditions? First condition is that the acquisition or construction of the property should be completed within 5 years from the end of the financial year in which the capital was borrowed. Not from the date on which capital was borrowed, but we look at the financial year in which the capital was borrowed, then the end of that financial year, and 5 years timeline starts from then, and within that timeline acquisition or construction should be completed. So there is a timeline for completion of acquisition or construction. And second condition that needs to be satisfied is that the SSE should furnish a certificate from the lender specifying the amount of interest. If both these conditions are satisfied, the deduction limit becomes 2 lakh, else the deduction limit remains at 30,000. Now the overall aggregate deduction for SOP or UOP up to 2 houses cannot exceed rupees 2 lakh. Okay, so if there is a property for which interest of rupees 2.5 lakh is payable, for which the limit of deduction is 2 lakh, the deduction allowable for that property will be 2 lakh. If there is another property for which the capital has been borrowed for say repair, on which say interest of 1 lakh has been paid, and the deduction limit is therefore 30,000. So the total deduction comes to 2,30,000 rupees, but 2,30,000 will not be allowed as deduction because the aggregate deduction cannot exceed 2 lakh. So even in this case, 2 lakh will be allowed as deduction. Now let's look at certain points. If a loan has been taken to repay the original loan, sometimes there is an original loan, and to repay the original loan, SSE might take another loan and pay interest on that another loan. So interest on that another loan is also eligible for deduction as per these limits, right? In case of LOP, DLOP, there is no limit. And for SOP, UOP, there is a limit of 30,000 or 2 lakh as the case may be. But for deduction for a new loan, it is important that the original loan should also be satisfying the conditions of deduction. So for example, if an SSE wants to claim the benefit of enhanced deduction limit of 2 lakh for a SOP on which a loan was taken earlier and now he has taken a new loan, right, on which he is paying interest. So interest on that new loan will also be eligible for enhanced deduction limit of 2 lakh if the original loan was also satisfying the conditions for availing the enhanced deduction limit of 2 lakh. The idea is that the new loan is basically an extension of the original loan. So new loan basically replaces the original loan. That is the idea. Now limits of 30,000 and 2 lakh are applicable in case of SOP, UOP up to 2 houses. This is what we saw, and beyond 2 houses is classified as DLOP, for which there is no limit. Date of commencement of construction and repayment of loan is not relevant, right? If it is a case of SOP or UOP and it is a case of construction, then the date of commencement of construction is not relevant, because what is relevant is date of completion of construction. Similarly, date of repayment of loan is not important. What is important is the date when the loan was taken or when the capital was borrowed. Now these two conditions regarding the timeline of 5 years and furnishing of certificate is not relevant for a LOP or DLOP because there is no limit of deduction in respect of interest. It is relevant only in case of SOP or UOP, and that too where property has been taken for acquisition of construction and for which we want to take the benefit of the enhanced limit of 2 lakh rupees. So enhanced limit of 2 lakh rupees is only available when? In the case of acquisition or construction. For repair, renewal or reconstruction, the lower limit of 30,000 applies, enhanced limit of 2 lakh doesn't apply. Now limits of 30,000 and 2 lakh are the aggregate limits under their respective category, and these limits are not per property or per loan, right? So for example, if interest of 30,000 each is paid for repair of 2 SOPs, so interest of 30,000 plus 30,000 is paid, so total interest of 60,000 is paid. So since the 30,000 limit is the aggregate limit under the respective category, the deduction will be 30,000 and not 60,000. Interest is deductible as per the above limits every year. So if the entitlement is for the enhanced limit of 2 lakh, up to 2 lakh deduction can be claimed every year on account of interest payable. Now we have already noted some time back that income under the head IHP is not chargeable until the property comes into existence, right? Let's take a case where the property is say constructed in the current previous year, but the capital may have been borrowed much earlier to the current previous year in which the construction of the property is complete, right? Thus, interest for such earlier previous years will not be deductible for those years. Why? Because the property was not in existence in those previous years, and therefore it will result in a hardship because SSC will not be able to take deduction on account of interest for those earlier previous years. To avoid this hardship, a provision is made to allow deduction of such interest, and this is referred to as prior period interest. Prior period interest means interest prior to the previous year in which the acquisition or construction gets completed. That means interest for those years in which the income was not chargeable under the head IHP, right? And since the amount of such interest may be big, therefore it is not considered prudent to allow the entire deduction of such interest in the first previous year in which income starts to get taxed under the head IHP. And therefore, deduction of such prior period interest is allowed in installments. So the deduction is basically spread out. How is this spread out? Deduction is allowed in 5 annual installments. When do the installments begin? Of course, with the year in which the income starts to get charged under the head IHP, which is which year? Which is the previous year in which the property is acquired or constructed. So this is the year of first installment, right? So 5 annual installments beginning with the previous year in which the property is acquired or constructed. And therefore interest, which is deductible as per the chart which we saw above, is not only the current year's interest, but it also includes the prior period interest. So interest is equal to current year interest plus prior period interest, and therefore the limits of deductions. So for LOP and DLOP there is no limit. For SOP and UOP there are the limits of 30,000 and 2 lakh. The 30,000 and 2 lakh limits apply for this entire interest, which is current year plus prior period interest, right? So what are the steps to allow deduction for prior period interest? First, we need to compute the amount of prior period interest. And prior period interest is what? Interest for the period prior to the previous year in which the property has been acquired or constructed, right? Previous year in which the property is acquired or constructed is the first previous year from which the income starts getting charged under the head IHP. Prior to this previous year, right, is the prior period. That means from the date, interest from the date of borrowing to 31st March immediately preceding the date of completion of acquisition or construction. Now this becomes the prior period interest. Then we deduct such prior period interest in 5 equal annual installments. And they begin with the previous year in which the property has been acquired or constructed, because that is the first previous year from which the income starts getting charged under the head IHP. The important point to note is prior period interest is deductible only when loan is taken for acquisition or construction, not for any other purpose, only for acquisition or construction. Whether the property is LOP, DLOP, SOP or UOP, it doesn't matter. But if the loan is taken for, say, repair or renewal or reconstruction, etc., prior period interest is not deductible, only current year's interest is deductible. But if the loan has been taken for acquisition or construction, both current year plus prior period interest is deductible, right? So this illustration will give you a very good overview and a clarity of what we have just now discussed. So for example, the loan is taken in the previous year or in the financial year 2014-15 and it is repaid in 2021-22, right? And therefore and it is a self-occupied property and the loan has been taken for construction, and the assessee wants to claim the higher interest deduction limit of 2 lakh, and therefore the time limit to complete construction is what? As we noted above, 5 years from the end of the financial year in which the capital is borrowed. So end of 2014-15. So 5 year is the timeline. Year 1, 2, 3, 4, 5. So by the end of 2019-20, the construction should be complete in order to avail of the enhanced interest deduction limit of 2 lakh. And construction is actually completed within 5 years, that is in year 4 in 2018-19. So what will be the prior period interest? Prior period interest will be the interest for this period, right? Because loan has been taken in 2014-15. So the interest starting from the date of the borrowing, that means within 2014-15 and till 2017-18. Why? Because 2018-19 is the first previous year in which income under the head ISP starts to get charged, right? So before this previous year, this is the prior period, and therefore 2014-15 to 2017-18 is the period for which you need to compute interest, and that is called prior period interest. And now the deduction on account of interest will be for prior period as well as for current year's interest. Why? Because it is a case of construction of property that we are looking at. So prior period interest deduction. So interest computed till 2017-18. So the deduction will start from 2018-19 and it will go on for 5 years, year 1, 2, 3, 4, 5, and it will go on till 22-23. 5 equal annual installments. So this interest that you compute, you will divide it by 5 and each installment will be allowed in this particular time period, right? As far as the current year's interest is concerned, you will start computing it from year 1, that is 2018-19, the year in which construction gets completed. That means income starts getting charged under the head IHP, and accordingly you will continue to pay interest till 21-22 because the loan gets repaid in this year. So from 2018-19 to 21-22, current year's interest will be allowed as deduction. So this I hope would make things very clear to you. Now let's look at certain points. Interest is deductible on due basis. We noted above that municipal taxes are deductible on payment basis. But as against that, interest is deductible on due basis. So whether interest is paid or not paid, it doesn't matter. So interest due but not paid is also deductible. Lender can be any person. So capital can be borrowed from a bank or financial institution, even a friend or from a family member. It doesn't matter. So long as capital is borrowed and interest is paid, then interest is deductible under section 24B on due basis. Penal interest. Now if you don't pay interest, sometimes a lender may charge you interest on unpaid interest, that is called penal interest. So mind you, penal interest, that is interest on unpaid interest, is not deductible. Only the interest on capital borrowed is deductible under section 24. Unpaid purchase price. Sometimes the buyer may purchase a property from the seller and may not borrow a capital from, say, a bank or from any other person, but he may make payment of the amount in installments with interest. So in that case, actually the seller and buyer are treated as lender and borrower, and consequently the interest that the buyer pays to the seller on account of payment of such installments can be deducted, because that is on unpaid purchase price, and that can be deducted as well under section 24. If the lender is outside India, then interest will be payable outside India, and in that case it is provided that interest will be deducted only if the TDS on the interest has been deducted. Interest payable outside India is not deductible if TDS has not been deducted, and there is also no person in India who may be treated as an agent who the tax authority may approach for recovery of tax. Now only interest is deductible under section 24B. An assessee may also incur expenses like brokerage or commission for arrangement of loan, and these type of expenses are not deductible. Only interest is allowed as deduction under 24B. What about repayment of principal? Repayment of principal is not deductible while computing income under the head IHP. It is, however, deductible from the gross total income under section 80C, which we will look at in detail in the video on 80C. Now, since there is a limit in the case of SOP or UOP of 30,000 or 2 lakh, there is likely a situation where interest payable is more than this limit, and therefore interest cannot be fully deducted under section 24B. So, is there an option to claim in the deduction of that excess somewhere else? So that interest can still be claimed as a deduction from gross total income in terms of section 80EEA if the conditions of that section are satisfied, and we will look at that section in detail when in the video on deduction from gross total income. So this is about interest on borrowed capital. Now we will look at certain special situations, and first we will take a look at how to select DLOP or SOP UOP properties to minimize income from house property. We noted earlier in this video that where there are more than two properties, which are classifiable as SOP or UOP, then up to two such properties, up to two, can be specified by the SSE at his option. So the SSE has an option, and they will be treated as SOP or UOP. The other properties will be treated as what? As DLOP. We also noted in the master chart for computation that computation of income mechanism is different for SOP, UOP and DLOP. For instance, interest deduction limit is 30,000 or 2 lakh for SOP or UOP, but there is no limit for DLOP. Municipal taxes can be deducted in respect of DLOP, but not for SOP, UOP. So selection of properties as SOP, UOP can impact the income taxable under the head IHP. So the SSE should try to make selection in a manner which is most beneficial to him. That is, which minimizes the income taxable under the head IHP. And how do we do that? So basically, we can follow 4 steps. Step 1, compute income from each property, assuming it is SOP or UOP, right? So there are properties 1, 2, and 3. For example, so in step 1, we compute income from each of 1, 2, and 3 property as if they are in the nature of SOP or UOP. Then in step 2, we compute income from each property assuming it is DLOP, right? That is step 2. Now in step 3, we create combination of properties where any two are treated as SOP, UOP and the others are treated as DLOP. And then we compute the income under the head IHP for each combination. So for example, combination could be 1 and 2 is SOP and third is DLOP. Other combination could be 2 and 3 is SOP, 1 is DLOP. Then 1 and 3 is SOP and 2 is DLOP. And accordingly, we create these combinations. And then for each combination, we find out the total income under the head IHP. And then finally, we select the combination with the minimum income taxable under the head IHP. So this is the approach that we should follow. Now, what we should carefully note is in step 3, when we are calculating or computing the income taxable under the head IHP for a combination and we are treating any two properties as SOP or UOP, then we should ensure that the total deduction on account of interest for SOP, UOP does not exceed the limit of 30,000 or 2 lakh as the case may be. This is what we should note. So for example, there is an illustration in which there is a case of 3 properties, 1, 2 and 3. And we are not going to look into this illustration in detail, but just showing you the approach. And all of these are SOP or UOP, and therefore the SSE needs to select any two as SOP or UOP, and the third will be classified as DLOP. So in step 1, we compute the income from each property assuming it is SOP or UOP. So the NAV becomes nil and we provide interest. We provide the deduction on account of interest, and then we arrive at the IHP, the income from such house property, which is nil in the case of 1, 30,000 loss and 2 lakh loss in the case of 2 and 3, right? In step 2, we do the similar exercise, assuming that these properties are DLOP in nature, 1, 2 and 3. And accordingly, we make the regular computations. We compute the gross annual value, NAV, and then we provide for standard deduction and deduction on account of interest. And this is the income from each property, right? In step 3, so once we have these amounts in place, in step 3, we create combinations of properties where any two are treated as SOP, UOP and others are treated as DLOP, and then compute the income under the head IHP for each such combination. So we create 3 combinations, and these are the 3 properties. In option 1 or combination 1, we take 1 and 2 as SOP. In option 2, we take 1 and 3 as SOP. In option 3, we take 2 and 3 as SOP, and we compute the income under the head IHP in each of these combinations, right? And as we noted above, we need to ensure that when we are allowing the deduction on account of interest for SOP, then that should not exceed the limit of 30,000 or 2 lakh as the case may be. So for example, if you look at option 3, and you look at the SOP, which was picked up as property 2 and 3, And if we see the amount of deduction for SOP for 2 and 3, it was basically 30,000 and 2 lakh. So the total of 2 lakh 30,000. But the aggregate cannot exceed 2 lakh. The aggregate cannot exceed 2 lakh. So we have ensured while computing income from house property under this option that the aggregate doesn't exceed 2 lakh. And accordingly, we then compute the income from house property. And now we see that the option 1 is the most tax efficient. Why? Because it results in a maximum loss of 1,55,500. So we pick up option 1, combination 1, and then the SAC can select property 1 and 2 as SOP, and consequently property 3 will be classified as DLOP. So this is how we take the approach where we have more than 2 properties classified as either SOP or UOP, and we are asked to uh, make the most beneficial selection for the SAC in the question as to what are the 2 properties which he should choose as SOP or UOP, because the other then will be classified and treated as DLOP. We will now look at a special situation where the property is SOP or UOP for part of the year and LOP for part of the year. So as we noted sometime back in this video, when we were looking at the types of properties, we noted that if it is a case of self-occupied property or unoccupied property, right? And if such property is actually let during the whole or any part of the previous year, or any other benefit therefrom is derived by the owner, then it is treated as LOP. It ceases to be treated as SOP or UOP and it now gets treated as LOP, right? Therefore, the benefit of nil annual value which is available in the case of SOP or UOP is not available. And as we noted in the master chart, the property gets classified as LOP and consequently computation is made as it is made for an LOP. So where a property which is self-occupied or unoccupied is let for a part of the previous year or any other benefit is derived by the owner, it is treated as LOP and benefit of nil annual value is not available. And this is the case even when the property is let out only for a day, right? For 364 days it is self-occupied or unoccupied, but for one day it is let out, then for the entire year, for the previous year, the property gets classified as a LOP. In that case, what happens? The computation is made on the basis that the property is an LOP and all values should be taken for the whole year, except the actual rent, which of course can be taken only for the period the property has been let out, right? Otherwise, all other values, the values while computing expected rent, that means fair rent, municipal value, standard rent, deduction on account of municipal taxes, standard deduction, interest on borrowed capital, everything is taken for the full year except the actual rent, because it cannot be for the full year. It will of course be only for the year for which the property has been let out. Now this situation covers a case where a self-occupied or unoccupied property is let out. However, you need to distinguish this case with a case where the property is let out but is vacant during the year, right? It is not self-occupied, it is let out but is vacant during the previous year, in which case we will check for vacancy allowance and then we will allow for vacancy allowance if it is available, and this is something that we discussed sometime back in this video. So this situation covers a case where self-occupied or unoccupied property has been let out or any other benefit therefrom has been derived by the owner. Then in such case, the computation is made as if the property is LOP. The next special situation is a situation where a portion of the property is used as SOP or UOP and a portion is used as LOP, right? Where a portion of a property is used as SOP, UOP and the other portion is let out. This is not a situation which we discussed above, where a property which is self-occupied or unoccupied has been let out during a part of the previous year or any other benefit has been derived therefrom. So we don't treat it this way because the portions are clearly demarcated, where one portion is used as SOP or UOP throughout the year and the other portion is let out, right? So since this is not a mixed case, but the portion is clearly demarcated, so both portions are treated separately, and therefore the SOP UOP portion is treated as SOP UOP, computation is made accordingly, and the LOP portion is treated as LOP and computation is made accordingly, right? So for SOP UOP, the NAV will become nil, and then we will only allow deduction on account of interest. For LOP portion, we will compute the expected rent, actual rent, and then GAV, and then allow for municipal taxes deduction, and then NAV, and then allow for standard deduction as well as interest on borrowed capital. So separate computations will be made. Now, while computing income from such property, municipal value, fair rent, standard rent, municipal taxes, and interest on borrowed capital are to be apportioned, and apportionment will be based on the facts as given in the question. So the question can say that 60% portion is self-occupied while 40% has been let out. So the ratio will be 60 to 40, and accordingly you will apportion these figures for making the computation. But of course, as far as the actual rent is concerned, you will definitely not apportion that because it is only for the LOP portion, right? You cannot attribute the actual rent to the SOP portion. You cannot apportion that. What you also need to note is, as far as deduction of interest for the SOP UOP portion or the LOP portion is concerned, you will apply the limits as we discussed in the discussion on the interest on borrowed capital. For LOP portion, there will be no limit as far as deduction is concerned, while the limit will be 30,000 or 2 lakh for the SOP UOP portion. So accordingly, the apportionment will be made, and then you will need to make separate computations for each of these portions. And this, mind you, this situation is different from a situation which is what we discussed previously. That is where a self-occupied or unoccupied property has been let for a part of the, or for the whole or the part of the previous year, or any other benefit has been derived, in which case the entire property is classified as LOP. Rather, in this particular case, there are clearly demarcated portions which are either self-occupied or unoccupied during the year, or they are let out during the year, and therefore apportionment needs to be made and computation needs to be made separately. Now, there may be a situation where property is owned by co-owners, joint owners, and this situation is governed by section 26. What is the tax treatment? We need to first find out whether the shares of co-owners are definite and ascertainable. That means, is there clear demarcation of ownership? For example, the question may state that A and B are co-owners of a property with share of 1:3. That means their shares are definite and ascertainable. If the shares are not definite and ascertainable, that means that the co-owners are basically in the nature of association of persons. So the income from house property is then taxed in the capacity of an association of persons, or AOP. But if the shares are definite and ascertainable, then income from house property is taxable in the hands of the co-owners. And then it depends on whether the property is LOP or it is SOP UOP. If the property is LOP, then what we need to do, first we need to compute the income from house property in the normal manner. And then finally, we need to apportion the income to the co-owners as per their respective shares, right? So if, for example, we compute the income from house property at 1,20,000 rupees, and if the shares of the co-owners are 1:3, then basically the share of the first co-owner will be 30,000 and for the other will be 90,000, and this amount will be the income from house property in the hands of each co-owner, and it will consequently be included in their total income. But treatment is different in case the property is SOP or UOP, in which case the income from house property is computed for each co-owner. It is computed separately for each co-owner, and since it is SOP UOP, each co-owner is entitled to have the NAV as nil. So each co-owner is entitled to the benefit of nil NAV, and each co-owner is entitled to deduction of interest up to the limit of 30,000 or 2 lakh separately, right? So 30,000 2 lakh limit doesn't apply in the aggregate for all the co-owners, but separately it is available for each co-owner, right? So if, for example, A and B are the co-owners sharing ownership in the ratio of 1:1, then NAV will be nil for both of them. And then each of them will be provided deduction on account of interest, right? And if, say, the enhanced limit of 2 lakh is available on account of deduction of interest because it is a case of construction of property by borrowing capital, then the limit of 2 lakh will be available to each of A and B. So for example, if the total interest payable is 3 lakh rupees, right? And if both A and B uh, pay interest of say 1,50,000 each, then 1,50,000 each will be the deduction which will be allowed to each of them separately, and consequently each of them will have a loss of 1,50,000. If that was not the case, then the interest of 3 lakh would have been allowed only to the extent of 2 lakh, right? But here the benefit of the enhanced limit is given individually to each of them, and the NAV is taken nil for each of them, and the income from house property is computed separately for each of them. But what we need to note is that the overall limit cannot exceed 2 lakh for either of them, which is something that we also noted in the chart on interest from borrowed capital. So what we noted is that this aggregate deduction of interest cannot exceed 2 lakh in the case of an SSE, right? So a similar logic follows here as well. So A is entitled to a deduction of 1,50,000 rupees, say if he has got one more self-occupied property in respect of which interest payable is say 1 lakh rupees. So he will not be allowed a deduction of 2,50,000 rupees, but the overall aggregate limit for A will be rupees 2 lakh. So if a co-owner owns other SOP, UOP as well, the aggregate interest deduction for such co-owner cannot exceed the overall limit of 2 lakh for interest deduction. In case of SOP, UOP, each co-owner is individually entitled to the benefit of 30,000 2 lakh interest deduction limit, and this limit is not apportioned amongst the co-owners. They are individually entitled to this limit. However, amount of interest itself should be apportioned. So if in our case the interest payable is 3 lakh, it is not that we are going to allow the deduction of rupees 3 lakh subject to a limit of 2 lakh to A as well as to B. So the overall deduction allowed by the tax department will be 4 lakh rupees, right? Which is not possible. So interest will be apportioned, and that apportioned interest will be allowed as the deduction, and the limit of 30,000 or 2 lakh will be available to each of them separately. Interest should be payable by the co-owner so as to claim deduction of interest in his hands. So this is how we treat the computation under the head IHP in the case of co-ownership. Now there may be a situation of arrears of rent or unrealized rent which is received subsequently. This is covered by section 25A. So there may be a situation where amount of arrears of rent is received or unrealized rent is received subsequently. What is the tax treatment? This is deemed to be income from house property in respect of the previous year in which such rent, that is arrears of rent or unrealized rent, is received or it is realized, right? So in the year in which arrears are received or unrealized rent is realized, it is deemed to be income from house property of that previous year, of the year of receipt or realization. And it is included in the total income of the SSE under the head IHP, whether the SSE is the owner of the property or not in that previous year in which it is received or realized. So it may well be the case that such realization or receipt may happen long time afterwards, right? And the SSE may have transferred the house property to someone else with the effect that the SSE is no more the owner of the house property. And one of the conditions for charge of income under this head is that SSE should be the owner of house property. But here is an exception where it is provided that even if the assessee is not the owner of the property in the year of receipt or realization, this amount will be deemed to be income from house property and it will be taxable under the head IHP. But the full amount will not be taxable, just like standard deduction which is otherwise provided while computing income under this head. Standard deduction from this amount to the extent of 30% of the amount will also be allowed. So 30% of the arrears or unrealized rent is allowed as a standard deduction. Now double taxation needs to be avoided, right? For example, if say conditions of Rule 4 were not fulfilled then, and therefore assessee was not able to provide deduction of unrealized rent from the actual rent, then now the unrealized rent is realized, right? Because deduction was not allowed then, so the assessee was not able to take benefit of unrealized rent at that point of time. Now it will not be justified to tax that amount again in the year in which it is realized, right? So it should not be taxed under section 25A if unrealized rent was not deducted from the actual rent in the previous year to which it pertained. Similarly, for example, if the assessee had taken arrears of rent in the original previous year to which it pertained in computing the income under the head IHP, so it should not be taxed again when it is received, right? So basically 25A will come into play where, for example, rent is increased with retrospective effect, so it was not taken into account in the year to which it pertains. And now when it is received, when the arrears are received, 25A will apply and it will be taxed. Similarly, if unrealized rent was allowed as a deduction because Rule 4 conditions were fulfilled and now it is realized, then 25A will come into play and amount will be taxed. Since the standard deduction of 30% is being allowed, it subsumes all the expenses, and therefore if the question provides for specific expenses on realization, for example on litigation, recovery expenses, etc., you should not allow separate deduction for these amounts because the standard deduction of 30% subsumes all such expenses. We now look at the tax treatment of composite rent. Now in certain cases, the owner of property may let out the building along with services like lifts, security, air conditioning, etc., right? Or the building may be let out with say other assets like plant, machinery, furniture. And a composite rent may be received in respect of building as well as such services or assets. Composite rents means combined rent, right? Now what is the tax treatment where a composite rent is received in such cases? Let's look at the chart. Where there is letting of building with services. Letting of building with services. For example, building is let out with security services, right? And a composite rent is received. So the rent needs to be split between charges for services and rent for building. Rent for building will be taxable under the head IHP and charges for services will be taxable under the head PGBP or IFOS as the case may be, not under the head IHP. For deciding whether the charges should be taxable under the head PGBP or IFOS, it will depend on whether the activity is in the course of carrying on of business or profession. If yes, then PGBP will apply, else the head IFOS will apply. So when we are talking about letting of building with services, the charges need to be split. Rent will be taxable as IHP and service charges will be taxable as PGBP or IFOS. Now when we talk about letting of building with other assets, plant, machinery or furniture, then it depends on whether both the lettings are separable or they are inseparable. Both lettings are inseparable when one is not acceptable without the other. For example, a multiplex is let out. Now multiplex is a building and it is let out with with air conditioning and it is fully furnished, right? So the building is let out with other assets and both lettings are inseparable. That means without air conditioning and without being fully furnished, the other party will not accept the multiplex. So both lettings are inseparable. In such case, income is not taxable under the head IHP. The entire income is taxable as PGBP or IFOS, as the case may be. But if both lettings are separable, for example, a house is let out with a car. Now this is separable, right? A house may be let out without a car, and the car itself may be let out without the house. In that case, rent for the building will be taxable under the head IHP, and rent for the car, that means rent for other assets, will be taxable under the head PGBP or IFOS. So this is the tax treatment for composite rent. Now we will look at the tax treatment in respect of property held as stock in trade, section 23(5). You would recollect that in the earlier part of this video, we noted that if the assessee is holding the property as stock in trade, its annual value is taxable under the head IHP. In the case of real estate developers, they generally hold properties as a stock in trade, and if especially those properties are just lying with them unsold, the annual value will be taxable under the head income from house property, and it may result in hardship. So a special provision is made to provide relief to them, right? In such cases, what is the relief? The annual value of such property, that means stock in trade, is taken to be nil. That means annual value becomes nil. Now, either there will be no income from house property because annual value, the NAV, is nil, or they will be allowed deduction of interest on borrowed capital if there is any. In such case, there will be a loss, right? So they will effectively not be charged any positive amount in respect of income under this head on account of stock in trade. So this is the relief. However, there are two conditions which need to be satisfied. One, the property should be held as stock in trade, that means meant to be sold. Second, the property on any part thereof is not let during the whole or any part of the previous year. That means the real estate developer should not be deriving any benefit or advantage out of such stock in trade which is lying with him. In that case, relief is provided to the effect that the annual value will be taken as nil. And therefore, either the income under the head house property for that stock in trade will be zero, or if there is interest, then it will be a loss on account of deduction of interest. But this benefit is not provided for an unlimited period. It is provided up to 2 years from the end of the financial year in which certificate of completion, COC, of construction of the property is obtained from the competent authority, right? So this is the previous year in which certificate of completion is obtained. Up to 2 years from the end of the financial year. So this is financial year 1 and this is financial year 2. So the benefit will be available for what period? For the financial year in which COC is obtained plus 2 subsequent financial year. That means for this financial year, for this financial year, and for this financial year. If the property or if the stock in trade continues to lie with the real estate developer beyond FY2, beyond this financial year, then from this financial year onwards, the relief will not be available and the NAV will not be nil, and consequently the annual value will start getting taxable. Now we need to note that limit of deduction of rupees 30,000 or 2 lakh for interest on borrowed capital is not applicable here. So this is the provision regarding stock in trade. Finally, in this video, we will look at the concept of deemed owner under section 27. The objective of this concept is to prevent tax avoidance, whereby individuals tend to transfer their house property to someone else, so that the income is not taxable in their hands but in the hands of some other person. So thereby they avoid tax. So there is a list of categories in section 27 which we will discuss, and in those categories, income from house property is not taxable in the hands of the actual legal owner but in the hands of the deemed owner. So as we noted under section 22, income from house property is taxable where the assessee is the owner of the house property. If he is not the owner, the income is not taxable in his hands, but section 27 creates an exception. So even though the individual is not the actual owner, he is deemed to be the owner under section 27, and consequently income from house property is taxable in his or her hands. First category is spouse or minor child. So there is an individual and he transfers his house property to the spouse or to a minor child without adequate consideration. So either the property is gifted or it is transferred for inadequate consideration. In such case, the individual transferor is deemed to be the owner even if not the actual owner, and the income from such house property is taxable in the hands of such individual transferor. So while the spouse or the minor child becomes the actual owner of the property, but the income from house property is taxable in the hands of the individual transferor. There are two exceptions. The first exception is where the individual has an agreement with the spouse to live apart, and in that connection he transfers the house property without adequate consideration. In such case, he is not deemed owner, right? So the spouse is the owner, and accordingly income from house property is taxable in the hands of the spouse, not the individual transferor. Second exception is where the transfer is to a minor child who is a married daughter. So if the minor child, not a major child, if the minor child is a married daughter and the individual has transferred the house property to such married daughter who is a minor child, then the individual is not deemed to be the owner and income from house property is not taxable in his hands. Now there could be a situation where the individual is very smart and instead of transferring the house property, right, because that will then be covered under section 27. So to avoid section 27, what he does is he instead gifts money, right? He says gifts rupees 50 lakh to the spouse or to the minor child, and the spouse or the minor child uses his 50 lakh to purchase a house property. So the effect is the same. So in that case, section 27 won't apply. But in that case, how will the net effect be the same? In that case also, the individual transferor will become taxable in respect of such house property. How? Because the clubbing provisions will apply, right? The clubbing provisions will apply even though the income from house property will not be taxable in the hands of the individual transferor, because section 27 doesn't apply, and the income from house property will be taxable in the hands of the spouse or the minor child. But because of clubbing provisions, the income will be clubbed back and included in the hands of the individual transferor. Second situation is that of a member of a housing society. Now a person can become a member of a cooperative society, company or other association of persons, right? And such entity has a house building scheme under which the member is allotted or is leased a house property. So for example, a group housing society, which is a cooperative society, and an individual becomes a member on account of which he is allotted a flat. So section 27 says that such member is then deemed to be the owner of such property, and accordingly income is taxable in his hands. Number 3 is a case of part performance of contract. Part performance of contract means that the contract has not been performed fully. There is only a part performance, right? So for example, there are instances where the house property is not transferred fully because the sale deed has not yet been executed. So the individual who is purchasing, he doesn't become the legal owner so far. But even in such case, if certain conditions are fulfilled, such person is deemed to be the owner, and accordingly income from house property gets taxable in his hands. What are those conditions? The condition is that the person should have been allowed to take or retain possession of such building in part performance of a contract, right? And such part performance of the contract should be as referred under section 53A of the Transfer of Property Act 1882. Now there is this Transfer of Property Act 1882 which details out certain features of a contract which can be, where it can be said that there is a part performance of a contract, and if these conditions are fulfilled, then the person who is acquiring the property is then considered or deemed to be the owner of such property even though the sale deed has not yet been executed. The first feature is that the agreement should be in writing. It should not be an oral agreement. Second condition is that the sale consideration is paid, or if it is not paid, it is promised to be paid by the buyer to the seller. Third condition is that the buyer has taken possession of the property. So buyer has actually taken possession of the property and sale deed is not executed, although certain other documents like power of attorney or agreement to sell, etc. have been executed. So in effect, if you see, it's only a matter of execution of the sale deed or registration of the sale deed, while all the other substantive elements appear to have been fulfilled. So it is considered to be part performance of a contract, and accordingly such person is then deemed to be the owner, and the income from such house property is then charged to tax in his hands. The fourth category is of a long-term lease. Now a person may acquire rights in respect of a building by way of lease, which is basically a long-term lease. So if a person acquires, say, a long-term lease of a property, such person or such lessee is considered as deemed owner under section 27, and income from such property is taxable in his hands. So the transfer by way of lease should be for 12 years or more. It should be for 12 years or more, and therefore if it is a case of lease from month to month or for a period up to 1 year, then that is not covered under this provision. The lease should be for 12 years or more, right? There could be a situation where, say, the lease is of 11 years and that is not covered then under section 27. But if the lease is extendable, say, for another 11 years, so the aggregate period becomes 22 years, which becomes a period of 12 months or more. So what is being said is lease for a term of less than 12 years. So it is less than 12 years, but it is extendable beyond 12 years. It is extendable beyond 12 years. That is also covered under this provision. Lastly, we have a case of impartable state. What is an impartable state? So sometimes certain estates, say belonging to a family, and there may be an ancient custom where the estate is belonging to a joint family, but because of that custom, the estate or the property may be held by one member of a family. That person is called the holder of an impartable state. Why it is called impartable state? Because such estate is not legally divisible or liable to partition. This is called impartable state, and the holder of such impartable state is also deemed owner under section 27, and consequently income is taxable in his or her hands. So these are the categories listed in section 27, and this brings us to the end of this video, where we have discussed how to compute income under the head income from house property. See you in the next video. Good day.